You are listening to the Retirement Lifestyle Advocates radio program. I'm your host, Dennis Tubbergen. Glad you decided to listen in today. Hey, if you're a new listener, this is where we talk about what's going on in the economy. We look at different times we've been in similar situations, historically speaking, and we try to sort it all out and tell you what it might mean for you and your money. And that exercise has never been more important than it is today, given the volatility of financial markets and given the extreme monetary policies that are now being pursued. You know, if you'd like to have a resource and get some more information on what you might consider doing with your assets, your 401k or your IRA, I would like to invite you to visit the website revenuesourcingbook.com and get a free copy of the #1 best-selling book that was released earlier this year. The book will explain to you how to use the two-bucket approach to potentially help you successfully navigate today's very difficult environment. The website, again, to get your free copy of the #1 best-selling book, Revenue Sourcing, is revenuesourcingbook.com. That website, again, revenuesourcingbook.com. Just let us know where you'd like us to mail the book, and we'll be glad to get you a copy of it out in the mail immediately. Joining me on today's program, Dr. Robert McHugh. Bob is one of the hardest working analysts in the business. His website, technicalindicatorindex.com, is a site that I visit frequently to get his perspective. So I know you're going to enjoy my conversation with Bob coming up in the next segment. You know, this past week, past guest here on the program and former presidential candidate Ron Paul wrote a very interesting piece about the Fed's new policy. Now, just a moment ago, I mentioned extreme monetary policy, and it seems that this extreme policy is now going to get even more extreme. I'm going to give you just a bit from Dr. Paul's article. He writes this: Federal Reserve Chairman Jerome Powell recently announced that the Fed is abandoning inflation targeting, where the Fed aims to maintain a price inflation rate of up to 2%. Instead, the Fed will allow inflation to remain above 2% to balance out periods of lower inflation. Now, my comment is simply this. First of all, it's really not a new policy. The Fed has been allowing inflation to run at a much higher rate than 2% for a very long time. And the reason I conclude that is that the measure of inflation, which is the Consumer Price Index, is extremely flawed. Now, past guest here on the program, John Williams, who has the website shadowstats.com, tracks the inflation rate using methodologies that the government used to use. And if you calculate the methodology that was used before the initial change in CPI came in 1983, according to Mr. Williams' calculations, the current inflation rate is about 9%. And if you've been to the grocery store, that probably rings a lot more true than 2%. Now, another index that is used to track the inflation rate, using a method that you and I might decide to use if we were given the task of figuring out what the inflation rate really is the Chapwood Index. And the Chapwood Index takes a look at consumer items in metropolitan areas and compares the current cost with costs at different points historically in time. And they calculate what the difference in price is, and that's how they determine the inflation rate. Now, the Chapwood Index also explains how and why this CPI calculation was changed. Well, in 1983, many of you probably remember that time frame, CPI the Consumer Price Index, according to the government, the inflation rate was 12%. So according to the Chapwood Index, the government modified the CPI calculation to save money. In order to save money on salary increases and entitlement benefits, which would mean Social Security payments, pension payments of some types, those are all tied to CPI. So the government changed their calculation of the CPI to reflect a much lower number. Now, CPI underwent another change in 1996 with the Boskin Commission. These changes watered down the number even more. Now, the Chapwood Index estimates that between 1996 and 2006, the changes made by the Boskin Commission saved the U.S. government over $680 billion. The Chapwood Index said that the CPI increase from 2008 to 2012 over that 5-year period of time was a total of 10.2%, but according to the research done by the Chapwood Index, in 2012 alone, inflation ran about that level. And incidentally, the Chapwood Index confirms within about a percentage point what Mr. Williams concludes. So this change by the Fed to let inflation run a little bit hotter than 2% or a little bit higher than 2% isn't really all that much of a policy shift. The Fed has been letting inflation run a lot higher than that anyway. Now, Dr. Paul writes that when you take a look at the debt that exists today, total household debt is over $16 trillion. Total business debt is over $16 trillion. And, of course, the federal government has a significant amount of debt. The Fed really has to keep inflation low to try to keep the government debt manageable and to try to keep the economy chugging along. That explains current interest rates, and it really explains the current demand in many parts of the country for residential real estate. Interest rates are extremely low. I talked to someone this past week who is paying 2.75% interest on a 30-year mortgage that they just obtained. That's significant. If you're borrowing $300,000 at 2.75% for 30 years, your monthly payment is about $1,225. If interest rates go to 7%, your monthly payment increases to just about $2,000. About a 70% increase in the size of the payment. Now, Dr. Paul makes a really interesting point. He says, and I quote, once the lockdown ends, or once the lockdowns end, I should say, the Fed's action may lead to a short-term boom. However, the long-term effect will be even more debt and continued erosion of the average American standard of living and the collapse of the fiat money system and the welfare warfare state. The crisis will likely be brought on by a rejection of the dollar's reserve currency status. This will be supported by both concerns about the stability of the U.S. economy and resentment over America's hyper-interventionist foreign policy. He concludes the question is not if the current system will end. The question is how it will end. I would encourage you to check out that piece that Dr. Paul just published. You can find it at Mises.org, Mises.org. Again, if you're just joining me for this segment, stay tuned. In the next segment, Dr. Bob McHugh will be joining me. And I'd also like to invite you to get a free copy of my #1 best-selling book called Revenue Sourcing. And Revenue Sourcing will give you some strategies to help you potentially navigate where we're headed as a result of these extreme monetary policies, To get your copy of the free book, just visit revenuesourcingbook.com. The website, again, is revenuesourcingbook.com. Just enter your address, and we'll be glad to send you a complimentary copy. Again, the website, revenuesourcingbook.com. I'll be back after these words. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen. Joining me on today's program is returning guest, Dr. Bob McHugh. Bob has the website Technical Indicator Index. He publishes his daily newsletter there. Bob is one of the hardest working guys in market analysis, and I'd encourage you to check out the website again, Technical Indicator Index. Bob also wrote a book several years ago called The Coming Economic Ice Age, and it's probably more of a timely read now than it was at the time it was published. So I would encourage you to check that out as well. Bob, hey, welcome back to the program.
Hey, thanks, Dennis. It's great to be here.
So, Bob, when I talk about technical analysis, there's probably a listener or two out there that aren't exactly sure what that means. So could you just jump in and briefly talk about the science or the art, or maybe it's a blend of the two that you practice, and what it is?
Sure. Markets are moved by fear and greed, and people buy and sell based upon whether they're expecting prices to go higher, but based on the world they live around, or they're expecting to go down, they sell or back out, of course. And what technical analysis does is it tries to measure the group psychology of mankind. The theory is that all information known by all people on Earth is reflected in the markets, and that we can measure the group belief of the markets, where they're headed next, and that the markets actually tell us where they're headed next based on a measure of this universal group think by everybody everywhere that knows everything about everything. And it's amazing that there are patterns that give us forecasts that are very highly reliable, and there are overbought, oversold indicators. There are other measures and momentum measures that all take into consideration sentiment indicators. They all take into consideration what people in general are thinking.
Well, Bob, since you were last on the program, we have had the CARES Act that was passed back in March. And as part of that, the U.S. Treasury is now borrowing money from the Fed and buying private corporate bonds. Seems like we have a lot of interference, if you will, or manipulation in markets, or at least some forces that are very impactful that haven't been there before. And then, of course, as you have brought up here on the program, there's something called the Plunge Protection Team, or the Working Group on Financial Markets, rather, that can intervene as far as stocks are concerned. So comment, if you will, about maybe how markets have changed from some of these outside forces over the last 30 years or so, and how it affects your work.
Okay, well, how it affects my work is interesting because it actually is taken into consideration in technical analysis. Technical analysis can anticipate and measure even involvement in the Plunge Protection Team, the Federal Reserve involvement. For example, when we had the crash in March, this was the start of what I believe is Grand Supercycle Degree Wave 4, which is correcting a 2-century rally. And it had bottomed at a level, what we called an A down move. So we knew there was going to be a B up move coming very shortly right after that. That's what technical analysis said. Contemporary with that, the Federal Reserve and the CARES Act started buying securities in the market by the trillions. And they added $2.5 trillion worth of securities to their balance sheet and printed cash out of thin air and exchanged that. The exchange went on with the Wall Street banks. So the Wall Street banks got rid of the securities from customers themselves, and they now found themselves with $2.5 trillion. The Plunge Protection Team, the President's Working Group, which was designed in 1988 after the 87 crash, allows the Federal Reserve to participate with the Treasury and the SEC and the Commodity Futures Commission to use New York City banks, mega city banks, to buy the stock market. They can buy futures on the stock market to drive the price up. So they took $2.5 trillion and invested a ton of it in index futures in the stock market, which was our wave B up. And wave Bs are generally in a grand super cycle wave 4 that we're in, will be very, very violent, very aggressive. And so we're just about at the conclusion of that B wave right now.
So, Bob, I'm sure there's a number of listeners out there that are trying to navigate these markets and their investments in a 401k or an IRA, just trying to get to retirement. And the fact that a committee exists that can actually manipulate markets in the United States, which is supposed to be a free market economy, which we both know is not true anymore, that probably comes as a shock to those people. So, what kind of advice would you give them about navigating this current environment if they're trying to save for retirement and invest the traditional way?
Well, it's a real challenge, and the Fed's balance sheet was less than $1 trillion back in 2007. It's now $7.25 trillion. So that's how much manipulation and cash they've brought in to the markets in that 13-year period. So there's a brain there that's outside the economy that is affecting our free markets to make things very difficult for investors. And the thing is, they don't always do it, and they stop every now and then the markets can freely fall. And it's kind of like stretching a rubber band. The more they get involved, the worse the next drop is going to be. And they started this back in the early 2000s, and we ended up with a Great Recession as a result of a lot of their manipulation back in 2003 to 5. So, what they're doing now is just going to make some next future market move to be even worse. What does an individual do? Well, you're going to have to diversify. You're going to have a lot of cash. One of the reasons we do this technical analysis is we can kind of get a handle on when it's ready for it to go back down again. And then we can kind of get a handle on when it's probably bottoming and it's going to go back up. So you almost have to do a little market timing in your investing, or go heavy in cash and that kind of thing. It's challenging though. It makes it tough. It makes it a lot harder than if they just stay out.
Well, if you're just joining us, we're chatting today with Dr. Bob McHugh. Bob's website is technicalindicatorindex.com. You can find his excellent newsletter there, and his most recent book, The Coming Economic Ice Age, even though it was published a few years ago, it's a very timely read. I would encourage you to check that out as well. Bob, what do you make of this new policy, or this what the Fed is calling a new policy, this average inflation targeting, which, as you kind of read between the lines, it's the Fed saying, you know what, we're going to keep interest rates low, we're going to keep this loose money policy for a long time, and if inflation runs a little bit hotter, so be it. At least that's my take on it. What's your take?
Yeah, I mean, that's what they're saying, but I think you're going to look at like real estate is popping. It's highly inflatable right now. High inflation in the real estate market. Products at the grocery store are very expensive. We basically are moving into socialism. That's what you're really seeing here. Government handouts, government manipulation of market. I mean, we are now in socialism. And what happens in socialism is shortages. That's economics 101. Socialism, government intervention, means shortages. Shortages on the supply side. You go into the grocery store, it doesn't have this, it doesn't have that. We don't have enough new housing, so prices go up. So they're actually making inflation much higher than it had to be, and they're not being honest about the consumer price index numbers, the wholesale price index numbers. They're not honest numbers. If anybody with any common sense just goes anywhere and looks in the paper, on the internet, you can see that prices are popping everywhere for everything.
So, Bob, do you see the end game here being a hyperinflationary type depression? I've interviewed John Williams on the program. That's his take. Alistair McLeod has said we're likely going to see a hyperinflationary outcome. Would you agree with that, or would you have a different perspective?
No, I'm agreeing with that, but they're not going to call it hyperinflation because they're not measuring an accurate number of inflation. They're making everybody think that there's very low inflation. They're keeping interest rates low artificially. If they were allowed to float, interest rates would probably be up around 10%. They're deflating the value of the dollar. It takes more dollars to do anything, to buy anything. So people are going to run short of cash, and they're going to run short of money income. And that'll create the coming depression side of that hyperinflation, the depression commentary analysis. Yeah, I agree.
So, Bob, you made a comment that we're moving toward socialism. So, do you see, as a result of this monetary policy that's being pursued, that obviously can't work long term, do you see these socialistic tendencies and trends becoming more extreme?
Oh, yes, I think so. I think the mood of the people, and they're being manipulated in their thinking, is I need help from the government. I want free medical care. I want handouts because I lost my job. I want extended unemployment benefits. I want this. I want that. I want the other thing. Hand the money to me. And, oh, by the way, push the stock market up, too, if you will. Would it be okay if you'd buy the stock market for us, Mr. Federal Reserve? And, it just creates shortages. It's just going to mean that we're all dependent upon the government for everything, and we're all going to be finding ourselves in the soup and say, what happened?
Bob, we've got time for one more question here in this segment. Seems to me that this policy, works until it doesn't. History teaches us that you can't just create money out of thin air without devastating consequences and some type of a reset. So what do you think the end game is here? How does this play out in your view?
That's a good question. I don't know if they're headed for a cashless monetary system with, electronic money, and this is the way they're trying to get us there. I don't know if we'll go back to the gold standard. Probably not. But gold is certainly an excellent defense. It's in a little correction right now, but they're inside a very long-term rising trend. So, that's a defense. But I'm not sure what their end game is. Perhaps it's a globalist totalitarian takeover of the world with one leader and all nations, reporting to that person through the United Nations or something. And this is the way to do it, to get the nations all in economic ruin and used to looking to government for solutions. So, maybe that's the end game. I'm not sure. It's uncertain times, that's for sure.
Well, we're chatting today with Dr. Bob McHugh, and we are going to get Bob's take on actual markets in the next segment when RLA Radio returns. Stay with us. You are listening to RLA Radio. I'm your host, Dennis Tubbergen. I have the pleasure again today of chatting with Dr. Bob McHugh. If you're not familiar with Dr. McHugh's work, I would encourage you to go check out technicalindicator.com. And his newsletter, which I read regularly, I would encourage you to check out. His most recent book, The Coming Economic Ice Age, is really, it was published several years ago, and it's really prophetic as to where we are today, so I'd encourage you to check that out as well. Hey, Bob, in this segment, let's talk to people that have an IRA or have a 401k, and they're trying to figure out what to do. And you had mentioned in the last segment that you're bullish long-term on gold, and obviously when you look at central bank policies, that's a fundamental reason to be bullish on gold, but what are you seeing technically?
Well, technically, gold is in a long-term rising trend, and it's going to go much higher over the coming years. But along any rising trend or any falling trend, you have pullbacks, you have corrections within that larger degree trend. And right now, we've seen for the last couple months that gold has been consolidating in a triangle sideways pattern correcting the rally that it had for the several months prior to that, all year really. And so once this correction completes, then we're going to see another pop up in gold. I have it in a wave 2 down now after it just completed a parabolic rally, which was the wave 1 rally. And progressive waves move in 5 waves. So if we're in a 2, that means there's a 3, 4, and 5 coming in our future, all in the up direction, 3 up, 4 down, 5 up. So I'm very bullish gold, but short term, it may need another drop. It's in the triangle. It's hard to tell whether it's going to drop out of the triangle a little bit to further correct down to the 1800 area or something like that, 1700 area, or will it be done with it once the triangle is complete? Will that be the full correction, and it'll start shooting up from here, well above the recent highs around 2100? But long term, I like gold.
So, Bob, what would your take be listening to analysts like Peter Schiff has been on the program in the past, and he's predicted that we'll see gold of 5,000. Jim Rickards recently said that we would see gold of 15,000 by, I think it was 2026, somewhere in that neighborhood. Do you think those are realistic targets?
Yes, definitely. When I just mentioned this 5-wave, 1, 2, 3, 4, 5, that's in a larger degree wave 3. Well, there's still a 4 to 5 going up after that. So long term, yeah, those targets are definitely doable for gold. You see the hyperinflation going on with printing. I mean, when the Fed prints $2.5 trillion in 6 months, which is completely unheard of, it's completely absurd, it's completely unnecessary and irresponsible, that is hyperinflation, and that is going to leak into all products and services and all real estate. And, gold is the defense. Gold sees the hyperinflation, means the dollar's worth less. And gold has definitely got those mega targets that they mentioned. I would agree with that based on the charts I'm looking at.
So do you have a thought on silver when compared to gold? Is that anything that you analyze?
Yes, I look at silver also. Silver's also very, very bullish. It's got a bright future, not to the extent gold does, based on the charts I'm looking at, but definitely it's going to be long-term bullish. It has a further upside to go. Maybe not the percentage growth that gold is going to have, because gold is a stronger monetary unit. It's more valuable in technology for industrial reasons, and with the uncertainty and safe haven issues that gold draws, gold will do better as we move forward into a more chaotic world. But silver is going to do okay. It's going to hang in there. It's going to trail gold, but it's going to go in the same direction over time. Yes.
So let's talk about someone that is investing in a 401k, and their options are really stock funds and bond funds and maybe some type of stable value fund, which is not at all uncommon. And let's start with stocks. I mean, when you take a look at where stocks are and you look at the fundamentals, and I guess that maybe talking about fundamentals would be interesting when I'm talking to a technical analyst or a technical expert here. But if you take a look at Warren Buffett's favorite indicator, the market cap to GDP ratio, I mean, that number is off the charts, which tells us that from a fundamental perspective, certainly stocks are extremely overvalued. What are you seeing from a technical standpoint?
Same thing. Overvalued, overbought, over bullish sentiment-wise, from a contrarian indication. Elliott wave analysis, the charts are saying it's ready to bottom or ready to go down again. Patterns are saying it's got a long way to go on the downside. So it's a consistency here that it's just the Fed's money that got leaked into the market to bounce us off the March lows. But the big picture is this is a grand super cycle degree wave 4 down, which we have never seen in centuries. And so this is going to be bloody. The problem with wave 4 is is that they can overlap. There's a lot of choppiness to them. There's a lot of bounce backs, but they work their way lower over time. So there is an opportunity to make some money with market timing, which is why I like technical analysis. It's very good with market timing. You can play the waves down and up, down and up. You're going to get a lot of those kind of down-up moves in a grand super cycle wave 4. So that's a way to make money. But the overall arching trend will be overall, by the end of this wave, it's going to be, the super cycle is going to be much far lower than we see now. And that'll correct a lot of the overvaluation that's going on in the stocks at this time. I mean, it's only a handful of stocks that are really driving this market up, and that's not one of the clues you have as to why it's the Federal Reserve involved in the working group to buying this market. It's the FANG stocks, the technology favorite stocks, Apple, Amazon, Google, Facebook, Tesla, Netflix. I mean, those are the ones that are sky high, and the rest of the market has not really done that well. So that's my thought on that.
So, Bob, can you envision a scenario under which the money creation intensifies and we see a hyperinflation type event where stocks go higher nominally, but they really crash in real terms when say measured in gold or some other unit? I mean, does the money printing somehow create some type of maybe an illusion as to what the value of stocks are?
I mean, that's true. It already has done that. After you put $7 trillion in the market over the past decade, you have to look at these prices and say, well, yeah, they're up nominally, but the real value of them is not, because the true inflation rate is substantially higher than the report. I use as a guideline the January 14th, 2000 high in the Dow is actually the inflation-adjusted top in the market. And everything that we've had since then, in real dollars, is not higher. The market has not really gone up since 2000. It's nominal inflationary dollars that push the price up, but in real dollars and inflation-adjusted dollars, when you look at the cost of living increases since 2000, the market is not even higher than it was in 2000.
So, Bob, let's shift gears a minute, because often when the stock market corrects, you see investors move to U.S. government bonds as a safe haven. However, given the current state of U.S. finances, and given that interest rates are already extremely low, do you see the safe haven changing moving ahead? And what's your forecast for U.S. government bonds?
This is where it gets interesting. As long as the United States is the biggest military and the dollar is the world's currency, the world's standard currency, they can get away with printing all the dollars they want, have the Federal Reserve sell them to the Treasury exchanges them for IOUs from the government, and then they have the money to keep bond rates low. But if the dollar is no longer the world reserve currency, if that changes, maybe the rest of the world gets fed up with how much money is being printed and how inflationary the dollar's gotten, and they try to change that, or the military of the United States weakens. Once the Federal Reserve is the dollar is no longer the world's reserve currency, then interest rates have to go through the roof, like the Weimar Republic saw in Germany way back. But as long as they can get away with being the reserve currency, they can get away with keeping the long-term interest rates low. And it also would be a safe haven draw for people that are concerned about the chaos that's happening now and will continue.
What's your take on highly rated corporate bonds now that that market has been altered since the CARES Act?
I don't like corporate bonds in this environment at all. I mean, you saw what happened to General Electric. You see these companies, they're struggling. I mean, they have to change the dynamic of work at home now. I mean, who knows what's real and what's imaginary in the corporate world right now? I'm not real happy about it.
Yeah, so we're chatting today with Dr. Bob McHugh, The clock tells me that we're going to have to end the conversation here soon. However, if you're just joining us, Bob's website is technicalindicatorindex.com. I'd encourage you to check that out. And his book, The Coming Economic Ice Age, is a must-read. And Bob, thank you so much for joining us on today's program. We'd love to have you back down the road.
Thank you, Dennis. It's a real pleasure to be here, and anytime that would be great. Thank you.
We will return after these words.
You are listening to RLA Radio. I'm your host, Dennis Tubbergen. Glad you're listening in today, and thanks again for Dr. Bob McHugh for joining me on today's program. You know, if you don't yet have the Your RLA app, let me tell you why you should get it. First of all, if you want to get the app, all you have to do is visit our website, retirementlifestyleadvocates.com. The website, again, is retirementlifestyleadvocates.com, and you can download the app there, and once you have the app, you'll be able to get access to our weekly webinars on which we talk about strategies and give you tips on how to handle your finances moving ahead in what is a very difficult environment. You'll also get access to our weekly newsletter, and you'll also be able to get the podcast version of this radio program. It is the only way that you can get these resources, so go ahead and visit retirementlifestyleadvocates.com, download the app, and you will be able to get access to all those resources moving ahead. We are all about education here at RLA Radio, so this is a new educational resource that we want to make available to you. Also, on today's program, we are making available a free copy of the #1 best-selling book, Revenue Sourcing, that was released earlier this year. If you missed your opportunity to get this book a few months ago, we are now making it available to you again. All you have to do to get your copy of the book is visit revenuesourcingbook.com, and we'll be glad to send you a complimentary copy. Just let us know where we should mail the book, and we will do that. The Revenue Sourcing book has a subtitle, The Retirement Planning Strategy for the Post-Pandemic Economy. And in the book, you'll discover a two-bucket approach and how to use it in your situation that may help you navigate the current environment. So again, revenuesourcingbook.com to get your copy of the book, and to download the free app, just go to retirementlifestyleadvocates.com. You know, here on the program and in the newsletter, if you're a subscriber, I have been talking about some trends that have been developing this year. Zero Hedge had an article that talked about one of these trends, which is the move away from major cities. It's a migration. It's literally an exodus. That's not too strong a word to use, away from cities into the suburbs and into rural areas. Bottom line, those with the means to exit the city are doing so as crime rates are skyrocketing and rioting in many areas persists. Zero Hedge published an article this past week about one of these cities. It's New York City. New York City moving companies report they have a rush of customers so high that it feels like, as one moving company put it, move-out day on a college campus. Now get these numbers. According to Flat Rate Moving, which is a moving data site, the number of moves from New York City has increased 46% between March 15 and August 15 as compared with the same period last year. Dutchess County, which is a desirable rural area, has seen a 232% increase in moves into the county. Ulster County in the Hudson Valley moves are up 116%. A successful New York City dentist said, "The first day we could move, we left." And the first day they could move was when movers were declared an essential service by Governor Cuomo. Where did they move? They moved to rural Pennsylvania where they had relatives. The article also talks about an unprecedented boom in suburban real estate. Now, this boom in suburban real estate is fueled by people's desire to get out of the city, but also their economic ability to do so, as many workers are now working online. July alone saw home sales in suburban counties near New York City increase 44% over July of 2019. And there were a couple of examples given as to how rabid this market is. Over 3 days in late July, a 3-bedroom house in East Orange, New Jersey was listed for sale for $285,000. 3 days, 97 showings, 24 offers, and went under contract for 21% over the asking price. Long Island, 6 people made offers on a $499,000 house in Valley Stream without seeing it in person after it was shown on Facebook in a live video. In the Hudson Valley, a 3-acre property with a pool listed for $985,000. It had 4 all-cash bids within a day of having 14 showings. This level of migration has not occurred since the mid-20th century. Now, Bloomberg recently reported on this, and if I were to ask you to guess the states that people are moving from, I would dare to wager that many of you would probably guess all 3. The top 3 on the list: New Jersey, New York, and Illinois. No surprise there. New Jersey's at the top of the list, and of all the moves in and out of New Jersey, 70% are outbound moves. So where are people moving? Vermont, Idaho, and South Carolina are among the most popular places to move. Vermont leads the list. 75% of the moves involving Vermont are into the state. The National Association of Realtors conducted a survey of its members in June and simply asked the realtors who are out there in the trenches every day working with people who want to move, where are your prospective buyers looking for houses? About half were looking for a new home in the suburbs or subdivision. 40% were looking to go rural with their next real estate purchase. Only 10% were considering an urban area in which to buy real estate. These trends will likely continue. Now, if you'd like to stay abreast of these trends and strategies you might consider to take advantage of them, let me again remind you, in case you're just joining us today, that you can get a copy of the Your RLA app, where you can get access to all our resources by visiting the website retirementlifestyleadvocates.com. The website again is retirementlifestyleadvocates.com. I'd encourage you to go check it out. The app is free. There's no reason not to do it. That's the program for this week. Hope you got something you can use, and I'll be back again next week.